I don't think any youngster find creating a soy sauce business sexy. But starting an EV business is definitely a lot more sexier, right?
Hi, Alvin.
Hi, Olivia.
Welcome to Playing with Fire.
Thank you for having me.
Yes. It's your first time on the show, right?
Yes, looking forward.
Great. Welcome, everyone. You're watching Playing with Fire, where we cover the hottest investment topics right now in the finance world. Today, we are covering a wide range of topics, but most importantly, it's all about wealth and how to grow it. Say hello to the CEO of Dr. Wealth himself, Alvin Chow. Hi, Alvin.
Hi, everyone. Thank you for having me here. Happy to share my thoughts about investments.
Thank you for coming on. Now, what do you think the audience can expect from a conversation today?
A lot of things we're supposed to discuss, like the macro, we're supposed to talk about investment in different jurisdictions, different geography, different asset classes. We're talking about inflation, recession, all this kind of thing. So it's going to be a wide-ranging topic.
I love the name Dr. Wealth. Why Dr. Wealth? Are you a doctor?
No, I'm not. So to clarify, I'm not a medical doctor. I'm also not like a professor with a PhD. And the name just came about because we should take care of our wealth, right? Not just our health. We do like a yearly kind of review of our health, but we don't really look at our portfolios, and we need to actually tend to it to make sure that our investment portfolios still fulfill our objectives. So that is how the name came about.
Right. So when did you start it? Because you are the CEO and you've got a whole bunch of other doctors out there with you, right?
It's a long story, but I'll just keep it very short. Okay. So when I first get into this investment world, that was quite a long time back, about 15 years ago. I was still studying in university, and that was where I realized that investment or personal finance is a very important topic that our parents didn't teach us. School didn't really teach us, so we have to figure out ourselves, right? And after you get your first paycheck, what are you going to do with it? Eventually, we incorporated a company to share more and have more structured way of doing education to the public in terms of financial literacy, because otherwise, there's a lot of information out there, but it's very unstructured. People may get lost.
So that's a key point right there, people not knowing what to do, especially right now with market volatility and the big word inflation, right? We're hearing it all the time. So what are some key signs or indicators of a pending market crash, or even touching on inflation itself?
Okay, so let's define what crash is, right? Because different people will have different kind of opinions or definition or what constitute a crash. So some would say that if the index drop more than 20% from the highs, it is considered a bear market, right? Which we have already seen that in the US markets. So for me, I do think that is one definition that we can use, right? And which means the US market is in a bear territory. And personally, I do think that there is probably more room to fall, considering there is a lot of condition that led up to it, right? The QE 1, 2, 3, 4, and inflation coming in due to the COVID catalyst that caused the supply chain disruption. So I don't think these issues are easy to solve. I'm quite contrary to what probably majority of the people are thinking. So a lot of people will think that inflation is here to stay and it's going to go up and things are going to get more expensive, and we hear a lot of complaints every day. Right?
Yes. So Alvin, where do we go from here with these mixed discussions about inflation?
So for me, I do think that the inflation has likely peaked. Okay, this is contrary, right, to what
likely
most people think.
peaked.
Likely
Okay.
peaked. Yeah. My view is that because I do a lot of momentum trades, which involves about riding certain trends, and we have been doing that for commodities in the past 6 months.
Okay.
And 2 weeks ago, I exited all the positions because it's not because I foresee certain things, it's because of the trading rules that I set it up. And if the prices start falling below the moving average, it triggers a sell. And that has actually happened 2 weeks ago. We talk about oil stocks, we talk about coal, you talk about grains, agricultural. All of them are trading below their moving average. So that is itself not a very good sign. It is more on the bearish side than the bullish side. So that's why I think that inflation is likely peaked, because the stock market is a leading indicator to the economy.
Isn't it also dependent on what the Fed decides to do?
definitely everything is related, right? It's almost like the idea of the butterfly effect. So when something happens, you have a cascading effect, right? And it's so dynamic that many things are moving at the same time. So I do think that the Federal Reserve, in terms of tightening the money supply, all these does have effect. Raising interest rate does have effect. So with all this in combination, that's why I think that the market is like signaling a potential recession. And with recession coming, demand is going down. And with demand going down means prices are falling. So that's why I think even from a fundamental perspective, I do think that it's showing us that the inflation is likely peaked.
Some analysts were saying on our live webinars that a good check-in to see where we're going would be September for the second half of the year. What are your views on this?
I would think every month will be a good check-in.
Every month, every week.
Depends on how involved you are, right? Because with the speed of development today, a lot of things can happen in a week, in a month.
Right. So bonds, right? Should we buy bonds right now? If you go into what we should do to hedge against these potentials.
So technically, bonds don't do well in a rising interest rate environment because they work in opposite direction. So if interest rate goes up, bond prices fall. And naturally, people will think that now is not a good time to buy bonds, right? But there are certain caveats. So one caveat is the Singapore savings bond, which par value is always fixed. So regardless of how the interest rate move, it is always at par.
Fixed.
And second is that I do start to see corporate bonds, right? They can give very reasonable yields. Some of them are trading below par because interest rates have gone up. And they may have just 1 or 2 years left to maturity. And I do think that if you are okay with the yield to maturity and you're okay with the underlying company that's issuing the bonds and holding it for 1 to 2 years until it matures, you will also get back the par value. So I do think that there is always opportunity even for bonds at this point in time.
So, for example, funds, right? You know about moomoo communities. They're always talking about whether we should engage in the apps function of like Moomoo Money Plus. Are you familiar with that? Like the cash plus function?
It's more like my understanding is more like a kind of money market fund. Okay, that's my understanding.
So what is the distinction for you?
I think money market fund is also okay, right? Because they are less sensitive to interest rate changes because of the tenure is very short, like 1 to 3 months. You won't see much impact, and it's still a good place to park the excess funds, right? In fact, you expect the interest to go up. Right, and together with even some of the banks are offering higher savings, so I would think that it has to be more competitive, right, to offer something higher than what the banks are.
So what about the REITs outlook?
REITs will be similar to the bonds that we discussed just now, right? They are sensitive to interest rate changes because if let's say a Singapore government bond, assuming that they hit like 5% interest rate, naturally, people will not buy a REIT that is giving 5% dividend yield because a REIT is riskier than, say, a Singapore government bond, which is AAA rated, right? So if interest rate goes to that level, bond prices have to fall in order for the dividend yield to go up to justify for the additional risk that investors are doing.
What you just explained seemed like a safety net right now while we ride out this volatility. So what is your personal preference for this?
For me, I take a much longer view of my investment portfolio. So I'm not investing for the next 1 year. I'm not investing for the next 1 month.
I'm the
Right?
same.
I'm investing for the next like
10,
20 or even 30, right, till I really retire. And given that horizon, this volatility period or this bearishness is just a blip in the entire time horizon, right? So from that perspective, I will see it as this is a good time to accumulate my long-term position, especially the growth stocks that I don't intend to sell as much as possible, right, to let the compounding work its magic. So I would say that I'm a buyer.
You're a buyer. Maybe I should be too, because I seem to be more on the safe side. I'm a bit risk adverse. Are you risk adverse? You're more...
I choose to say that I'm balanced, right?
That is so hard though, especially now.
But it depends on who you compare to.
Okay, yeah, that's right.
If you compare to someone who is like very into leverage trading, if you just buy stocks alone, it looks safe, right?
Yeah.
But if you compare someone who just put everything in a fixed deposit, then I'm risky. So I think everything is relative.
It's relative,
and
right.
it's just how much you can tolerate in the markets. There's no right answer.
So cash and gold as hedging tools to safeguard against inflation.
Their definition of hyperinflation is that when inflation rate goes above 10%, then gold start to perform, which was something in the 70s, the 1970s. So now inflation rate is at 8+% in the US, and which means that it doesn't have enough for people to switch from USD to gold, so that the gold demand doesn't go up, and that's why the gold prices is subdued in a certain sense. So if, let's say, really the inflation really get bad, then maybe gold can be a good hedge. So it depends on the personal view again, right? So if you think that inflation is going to go beyond 10%, gold might be a good hedge. Then in terms of cash, is pros and cons, right? Because if we talk about holding too much cash and inflation is high, your purchasing power get lowered as time goes
100%.
by, right? So that is always not a good situation to be in. So as much as possible, I would think that invest enough, but given that the market is still crashing, leaving some cash for dollar cost averaging as it goes down may make sense. So I would say if, just a ballpark figure again, if someone who is like more than 50% invested already, then maybe you should be more discerning in how you want to invest at this point in time. But if, let's say, you have a lot of cash lying around, maybe you're only 10% invested and 90% in cash, then I think it's time to do some work and not just leave it there and get your purchasing power eroded in the process.
So China, right?
Yeah.
Always a hot topic. With the resurgence that happened in the last couple of months, and also the potential delisting for US markets. What are your thoughts on this?
I'm a China bull, okay, so that's the baseline context. I have majority of my stock investment in China, mostly China stocks, basically. And my view is that China have a lot more growth stocks that are undervalued as compared to the US. So I would think that it is very difficult, right? As I mentioned, I prefer those predictable industry that have very little competition, right? Like, I don't think any youngster find creating a soy sauce business sexy, right? but starting an EV business is definitely a lot more sexier, right?
So US side. So what about the Chinese stocks that are listed on the US market?
The biggest concern is always about the delisting risk, and until now there isn't really any concrete action. So I'll say it's a lot more talk than action for many years already. This is nothing new, right?
What would be a concrete indicator?
When we really see companies being delisted, then I would say yes, right? It's not just one or two, but there is maybe a group of them, 5, 10 of them getting delisted because of this new ruling. Otherwise, I don't think it is going to happen. And we also have seen how certain developments is favorable for this Chinese company to stay listed. China decided that, okay, we are going to open up the books, and the regulators are working with the American regulators. So these are signs that both sides are probably working towards a certain reconciliation of how they want to move this ahead. If, let's say, an investor is concerned, right, we can always look at those companies that have a listing in Hong Kong. There's a H share equivalent, and some of them are fungible, like Alibaba, right? 8 shares you can exchange for, 1 share in US you can exchange for 8 shares in Hong Kong. So it is fungible. You can convert from one side to another.
Would you say that the effects of inflation has yet to hit us?
There is definitely a delay, right?
Yeah.
So when we talk about the stock market, is a leading indicator. So interest rate has been going up in the past few months, and we will only get that impact maybe few months down the road, right? So it is not done yet, but the stock market is definitely leading in head of the economy.
Bringing it home, right? Somewhere closer. What are your thoughts on investing in Singapore?
Singapore has been a bright spark this year, actually. It has actually outperformed many markets.
That's why I asked.
It was green. It was green for first few months, right? Until, unfortunately, by the mid-year, it has gone to the red side as well. But Singapore has always been a very stable market. The prices doesn't go up a lot, but it doesn't come down a lot. So to me, it feels more like a bond than a stock. They should rename it Singapore's Bond Exchange. Just kidding. Okay. But some investors love the stability, especially retirees, right? They don't want so much heart attack, and if they get their dividends, they're happy. And I think that Singapore market is the best place for dividend investing. there's no dividend taxation, dividend yield tends to be higher as compared to the rest of the world, right? So if you are a dividend investor, Singapore is definitely a very good avenue to hunt these kind of dividend stocks. And yes, right, rising interest rate again has some impact on these dividend stocks. Again, like what we talked about just now, right? With rates rising, people will demand higher yields, so prices have to fall, and that means that should see positively as a chance for you to accumulate dividend stocks at attractive yields. As long as their business can continue to make money, right? Even in inflation period, they can pass down the cost to consumers, although it's not a good thing, but
No.
but some business have the ability to do so, right? Maybe one example is like maybe Sheng Siong, right? A supermarket, it will be able to pass down the higher cost to the consumers, because grocery is a need, not a want. And so I do think that there are opportunities like this even in Singapore market.
Conclusion. So Singapore stocks, or at least investing in Singapore, have been relatively stable this year, yeah?
Definitely, I would say so. I don't hear any Singapore stock investor losing sleep. So I suppose it's working for majority of them.
Okay, I think I need to consider doing that as well. Thanks for sharing that. So I'm really interested to know, what is Singapore's positioning amongst the ASEAN countries in terms of financial investments?
Definitely, it will be the most attractive markets, and Singapore has always positioned or brand herself as the Asia Pacific HQ, or even at least the ASEAN HQ, right? Attracting a lot of MNCs to come to Singapore to set up a business, and using Singapore as a regional HQ to branch it out to other ASEAN markets. So it's definitely a leader, right, in the region, and I believe it will be so because the government always move on to the new direction, right, wherever the global economy is moving to, right, like green energy, green financing,
Yes.
which the government has
ESG
making a lot
investing.
of effort. So it is a pioneer, I would say, in ASEAN, and it has to continue to push that frontier in order for Singapore to be relevant to the world.
Especially with the Singapore Green Plan, right,
Yeah.
upcoming.
Yeah.
I think those are some spaces that we could look at for investments, would you say?
Yes, definitely. And even for the finance side, because when it comes to all this sustainable development, green financing is a big thing. And of course, the Minister Heng has also said that be careful of greenwashing. People are finding the kind of excuses for them to raise money via the sustainable bonds, all these kind of things. So I think it is generally still a good thing, right, that we're moving towards.
So Alvin, Dr. Wealth, where is the biggest opportunity right now? What's your market outlook?
I'll be biased, right? I'll be biased as I say that. I'll coming from a point of view that I love the growth stocks, especially the ones that are in China. The big theme that I share about consumer brands. And that is where I think is the biggest opportunity. You can invest through these volatile times. And of course, the volatile times will not end just because of this episode. It will come back maybe many years later. But I do think that really taking a longer view, that is where the opportunity is. The China consumer brand growth stocks.
So compounding effect in this sense, is that something that you've tied in your own portfolio?
It is nothing new, right? Because it is a Warren Buffett kind of concept, right? So the analogy is this, okay? So he said that use snowball as an analogy, right? He said that in life it's like you find a slope that's long enough and you just roll the snowball. And you will just compound, right? Because the ball will just get bigger and bigger and bigger. So the key thing is that what people miss is that they think that it is the speed that the ball is rolling, but it is not. It is the length of the slope. If the length is almost infinite, that means that the ball can roll for a long time, can compound for a long time. So when it translates to growth investing, it is not about finding stocks that grow the fastest. It's finding stocks that can grow the longest, the sustainable growth stocks that we're talking about. So that's where compounding effect is found. It's not the stocks that grow 50% 1 year, 2 year, 3 year, then it just punctured. Then compounding effect stops.
Thanks, Alvin, for that. Now we're going to take some community questions. So we've heard you and we've picked out some of the best questions for Alvin, Dr. Wealth. And yes, would you like to answer some of the community favorites?
Definitely. It's my pleasure.
So the first question,